Okay. Okay.
Yeah,
Okay.
so we mentioned, so chapter 15 is the last chapter we cover. And because of the nature of the contents, it's kind of newer managerial accounting topics than the ABC costing or CVP analysis budgeting. Those are very kind of the classical standard managerial accounting topics. And these pricing decisions, we have like plus cost plus pricing, or if the cost is already, like the price is already fixed by the market. Most of the products you can see around, right? Even you are the manufacturers or retailers, the price is not really set up by my own company. It's really kind of set up by the whole industry, right? The average pricing or by the competitors as a group. So I have to comply with this pricing level. What I can do is control my production cost or retail cost below the pricing, so I can still earn some profit. That's kind of a relative new phenomenon in terms of the pricing strategies. We used to have is this cost plus pricing. So because like the competition has not really been this high, I'm not really saying it was not a high or competitive, but it's better, it's much better 30 or 40 years ago than current days, right? So like, and you have more competition domestically and now adding globally. And for each, especially the traditional industry, consumer electronics, clothings, right, stationaries, general supplies, so it's really crowded with hundreds, thousands, even like 10,000s of competitors, manufacturers in the same industry. So 1 cent, even 5 cents of the price will make a difference to the consumer choices. So in that case, the target pricing or target costing become more become the reality. Then, I know my cost, then add some profits to my cost, then I can decide my pricing. Lots of the companies, they don't have the luxury to set up the pricing based upon their cost already. Right? So they have to follow the market price and then push a cost to make the products. So that's kind of the two parts of chapter 15. So this week we focus on we call the traditional model we call plus, so cost plus pricing, right? So we know our products. We mostly use the cost to make the products or market the products and adding some profit, so markup rate. And we'll introduce two of the models in for this week. So one is based upon so you can see this. They call economic profit maximizing pricing. And this one is more closely related to the economic description of the revenue demand and also the cost demand. So revenue curve and the cost curve as we increase or decrease the production volume. So you can see the curve of the kind of like ideal, or we must draw the curve so we can see how the revenue will change and how the cost will change. Then we found a best selling point, a production volume, so we can maximize the difference between revenues and the cost. So that's kind of the margin of your profit. Or you use a more simple like cost plus model, right? Like I mentioned, so you have your cost based upon your financial accounting, managerial accounting system. It doesn't matter you use a variable costing system or absorption costing system. So we can estimate a markup, like the profit margin, then we add it on the cost to set up the pricing. But anyway, so those are kind of the traditional, right? So like, ideal situations. And but let's starting from the slide. So overall, you can see the pricing decisions is not only about the market or not only about the cost. So it's a combination or integration, interactive from different forces from the market, from the cost, and even the political, legal, and the reputation issues of the company. So it's a combined. I guess these parts, as accounting people, we are not really experts on the this overall market analysis compared to the marketing people, right? So I believe you should have taken, or you are probably there's something in your curriculum for the MBA students, marketing research, I believe, right? So like the marketing research give you more specialized on this, especially, research on the customer demand, competitors, right? So like how that will impact the market share of your companies or your own marketing strategies. So it's a collaboration of accounting. As accounting, we offer data mostly on the cost side, right? So the production cost, period cost, right? So we give you different definitions and ideas about the cost data. So combining with the customer demand and your competitor perspective, right? So which type of industry you are in, you are on the high end or you are on the regular consumer market, or so like really depending on your market status. And we can have some fundamental pricing decisions and then adding the political factors, because some of the industries like energies, utilities, the governments or some regulations will play a critical role in setting up the prices at electricities or the utility bills, and the legal issues to avoid monopoly, right? So you cannot really collectively with other companies set up the price too high or too low, right? So there should be a reasonable price level to protect the consumers. And also your market image. If you are really the super luxury industries, right? So they have to price their products, right? So way higher, like the middle level, or like so you want to differentiate yourself from your competitors, right? So that's like we can see the luxury brand on the like the woman's handbag, right? The high-end clothings. So, and even that's normally we understand they really, for the really the super high brand, they don't really have discount available, right? So even they can probably move the products, right? Kind of the older products from the shelf, but rather than give any discount. So their pricing strategy is protect their long-term image, and so they can continuously maintain their high pricing strategies, right? It's really a complex dynamic system, okay, playing in this like overall pricing decisions. So that's kind of the overall, the first learning objective, okay, the 4 factors affecting the company's pricing decisions. And then they talk about this reiteration or interactive. So between your market forces and the cost inputs for the products in the market, right? So that's the data. As accountants, we can help the managers to understand our cost structures. And when we have market forces to force us to lower the cost, or in most of the cases, to increase the profit range, or so you can give recommendations, which are the potential areas we can improve the cost efficiencies, right? So the variable cost, so which variable cost items or which fixed cost items. So lots of the cost analysis and the cost reports are offered by the managerial accountants to help the managers understand, predict, and make planning for the cost plan, like cost strategies, so we can meet or beat the market forces, okay, to survive and continue to develop in the market. And then let's get on to the so the first, there are two, I'm saying, like, so from the cost side, okay, if the company can control the pricing strategy, like I'm saying, so the pricing is mostly driven by the cost curves, like the real cost to make the products. So in another way, so it's more on the supply. So the supplier has more powers to decide the cost. So we have two models we can follow. The first one, they call the economic profit maximizing price. And in this part, I like the chapter because it's really expand. So like first us to think about the, our discipline, this connection from like between marketing, economics, and accounting, even like the productions, right? So either collective efforts from the different disciplines. For you to use the economic profit maximizing price is analyzing the production data and sales data related to the quantities in different levels. So in other way, so we analyze a certain range of our productions, like for example, from 0 to 20,000. That's normally our manufacture range. Then we'll analyze the revenue pattern and the cost pattern in this range of productions. The cost pattern, we already use it in CVP analysis and the cost behavior, but this is the revenue curve. You may wondering, okay, why this is not a linear or straight line as we use in the CVP analysis. I know we just we completed the CVP graphing, right, from your group case studies. For that one, when you construct the CVP graphing in Excel, if you can recall, the revenue is a straight line. The total revenue is a straight line. The total cost is also a straight line. But here, why the revenue appear as a curve? And the rate of increase going down as the quantity increases. In the book, they have more clear, like you can see, if I can draw. So this, like they call, like this is a marginal decrease, right? So yeah, in the beginning, I have this level of quantity difference and my revenue increase by this range, right? So they call marginal revenue. So increase of certain quantities and revenue will increase like this. I will label as number one. Then I'm seeing another level, like similar quantity increase. But now you can see the revenue increase very clearly. You can see the distance of the revenue increase is smaller than in the early quantities, right? So the increase of revenue of 2 is less than the increase of revenue in 1, because they call this is the price elasticity. Okay, when price increase, the demand will decrease. So we'll increase the quantity continuously, the customer demand will decrease. We couldn't really sell the same quantity as in the lower volume range. So this is different from the straight CVP we used. Under the CVP, assume in the relevant range, we can continue increase our sales volume as a straight line, right? Doesn't matter. So between 1 to 100, and then between like 400 and 500, the revenue increase will be the same. Okay, so we didn't take a consideration of the price elasticity. But elasticity is true in the economic world. So you continue to do this, you can see if you're getting higher in the quantity of sales, the increase of the revenue or the margin of the revenue, if I label as 3, will continue decrease, right? So eventually when you have really the quantity in the large scales, the revenue become almost flat. Interesting, right? So that's kind of in the peak sales. And then you wouldn't really increase your revenue significantly if you increase the quantities, right? So the total revenue curve. And this is really showing the marginal revenue decrease. And then they have additional line to looking for the dollar sales per unit. So the marginal sales, as the quantity increase, we can see the sales price must decrease to sell higher quantities, okay, which we kind of ignore in the original CVP analysis. In that case, we assume we can maintain a consistent pricing. And then the revenue per unit, okay, decrease marginal revenue, okay, even with a steeper rate. Because this is the price per unit, and this is the marginal revenue per unit. And these collectively explain what we observed in the prior total revenue curve. Okay, so this is the revenue curve. And now looking for the cost curve, similarly, overall, we are seeing a curved rather than a straight total cost line in the CVP analysis. In the CVP, it's like we did this. So we are analyzing the cost in the relevant range. So means your normal productions. So we are simulating it as a straight line. But if you consider all of your quantity range in the lower quantity and the higher ones, you're adding these curving factors. Right? And they say, okay, so some parts they break it down into here. So when we increase the quantity initially, the cost per unit will decrease because of the economy of scale factor we explained in prior chapters. Because for the given amount of the fixed expenses, remember we have the variable cost per unit is constant, but a fixed cost per unit decrease as we increase the quantities initially. So overall, in the beginning, the average cost decrease when we increase the units. So that's kind of the early curve. They call the total cost increases as a declining rate. And the underlying reason is your average cost decrease initially. So I will just use C per unit. And that's like you think about,
Sorry.
oh, this is, yes. Are you talking to me?
No, go ahead. I couldn't hear you at first.
Oh, okay, yeah. So initially, because of the economy of scale, when we increase the units, the average cost will decrease. So the total cost is showing a declining curve. And let's think about, oh, this is my original facility level with all of my like building investments, equipment investments. And after we reach kind of like in the middle, you can see the total cost curve is become going up. And that's normally when we reach a certain level of production, you need to increase your fixed cost. Like I need to add equipment, delivering vehicles, or I need to rent more production facilities. Fixed cost will increase. So the cost will take more fixed cost per unit. So it's starting a increasing curve and an increasing average cost. says like overall economic analysis. And if you're looking for the unit cost curve, like they call marginal cost, as comparing to the marginal revenue. So the marginal cost is really like a ball, like curve of a ball, or initially decreasing, average, okay, quantity. So, and when you reach to the high of the economy of scale, so you are fully utilizing your fixed cost expenses. So we are fully, when you reach, in another word, when you reach your full capacity, like for example, our TSU, when we reach the maximum student enrollments given our current building capacities, faculty, number of faculties, and staff supports, right? For example, 15,000 students. We are the most efficient, right? So we have the kind of like lower cost per student in terms of the, maybe like the teaching, like cost per unit become the lowest. Make sense? So fully utilizing our classrooms, faculty hours, and the staff supports. So we reach to the lowest cost per student, or in industries cost per unit. Now, but when we want to increase our enrollment to 20,000, right, so larger, 25,000, we have to expand our campus by building more, maybe like more classrooms, like buildings, expansion, libraries, hire more faculties and supporting staff. Then your fixed costs are going up, and then the cost per student or cost per unit will increase for the next level of your production volume. And this wouldn't really going up, like it will someday going down again, but kind of too long for us to observe. Okay, we are just observing this limited range of productions. But just the cylinder is a best, okay, like lowest the total cost. And now if we combine the revenue and the cost curve together, so I think I like this one, because we see the differences, right? So I think this is kind of like a part of our CVP graph. And we can cut the lower or maybe higher, okay, like in this range, we can kind of simulate, right? Simulate to straight lines. But now you can see, you can analyze the difference between the revenue curve and the cost curve, because the difference or the distance is our profit. And in terms of a school, even we are not seeking profits, you can think about if like you are a private school, and that's all of your tuition and other revenues, and then all of the cost of the service, right? So, but anyway, there is a point we have to maximize the profit with the quantity of Q and the price level as P. Okay, denoted from the economic terms. So every company theoretically, when you can really describe your revenue and the cost curve as accurate as this, theoretically, we should find a point for the optimized production volume and the pricing level. Okay, that's your, we call profit maximizing price and quantity levels. And if you use the unit curve, that's the time when your marginal revenue and marginal cost interact. We have a straight line for the revenue marginal, but the cost curve is like a ball, like curved, so it's not a straight line. But they do have intersection, and this is a quantity and pricing level. Okay, as they project on the price line, this is the price line. So be careful. Okay, this is the marginal revenue, not the price yet. But we can extend this, okay, to the price line and find that this is the optimize the pricing and this is optimize the quantity, okay, for this economic perspective of analysis. But again, like for you to develop these curves, in the slides, we didn't offer the tables or how you draw this cost or revenue. In the book, they have the tables to showing you the different level of revenues and cost with the quantities, right? And for company, imagine if you work as the accountants or finance, we are supposed to offer those cost information and the pricing data so we can simulate, right? So we can input into the softwares, they can simulate the lines and use the machine learning, use the math or the statistical tools to draw the line for us and find this optimize the point of pricing and quantities. Okay, that's a theory. But when you really work on the realities, so the price elasticity sometimes is not very easy to understand or predict. Like what I mean is, so when you increase the, for example, like the price by $10, how much demand of the customer will change? Like, how elastic the customer will respond to price change, increase or decrease? Is linear or is non-linear? If it's non-linear, how much the curve will be, right? So if I increase my like price by $10 and my sales probably decrease by 200 units or, stay flat or whatever. And that's really, you need to have a really extensive market research to get the most accurate results, right? So like that's all really relies on the marketing research, but no one can guarantee the research or prediction will be the real situation when you change your pricing strategies. So that's like they later talk about the limitations of this maximizing profit model. So a firm's demand and marginal revenue curve are very difficult to discern with precision when we do planning research and predict or theoretically. There are, the economic tools you can use, but the data we input into the models is critical. And then also the marginal revenue, marginal cost paradigm is not valid for all firms of market. And that's because you have, like I'm saying, because of your market, like either consumer industry or is luxury or is differentiated markets, right? So in the industry, you have limited competitors or you have like endless competitors. Is a new products and so it's really depending because some of the markets wouldn't really react or behave as we use this marginal revenue or marginal cost like classical ways. So in that case, so this is a choice, right? So it can be a supporting, you can use this one as a supplement. So supplement tools when you use the cost pricing or target pricing tools, or use this one as a supplement, but rather than just use it as your single tools to determine the price. Okay, that's like the point. They finally think about. So that's like kind of help us transition to the next pricing strategy. Okay, they call cost-based approach or cost plus approach, okay, rather than using the economic models. The cost plus approach is more simple is really depending on the financial data about the cost structure. Then you can just add some markup, okay, based upon the combination of the market factors and your predictions. So more costly and less costly, but they can work together, okay, as supplementary to each other rather than you only can use one of them exclusively. Okay. So they can be used inclusively in the decision-making approach. Question?